You're listening to Simply Put, a podcast from FHN Financial. Filling in for Will Compernell, I'm your host, Mark Streiber, economic analyst at FHN Financial. The term bond vigilantes re-emerged last week as yields jumped after Moody's became the third major rating agency to strip U.S. debt of its AAA status. Moody's cited more than a decade of poor fiscal budgeting and the ballooning federal debt, which according to the CBO, President Trump's one big, beautiful budget bill does not address. On today's episode, we talk with Joseph Wang, a former trader on the Fed's open markets desk, a principal at Monetary Macro, and author of the website Fed Guy. Please note that this interview was conducted at the end of April and should be interpreted in the context of that time. Stay tuned. Coming up soon, our interview with Joseph Wang. But first, a quick market update. Economic data reported in the past 2 weeks has suggested that the economy is doing better in the second quarter than originally thought. S&P Global PMIs reported last Thursday showed both growth in manufacturing and services sectors, with both indexes beating street expectations and rising to 52.3. New and existing home sales were weak again in April, even more so than in recent years when sales were being suppressed by high mortgage rates. Durable goods orders fell in April, as expected, following an outsized gain in March due to a surge in aircraft orders. Car orders tumbled in April, causing a 1.3% decline in core capital goods orders. Dealers are expecting higher prices and lower sales volumes due to tariffs, especially after the surge in sales in March. Consumer confidence unexpectedly jumped in May from 86 to 98, beating expectations of 87.1. The rise is almost entirely due to the jump in expectations, which surged now the temporary trade deal with China is in place. President Trump announced a 50% tariff to be placed on goods from the European Union last week, citing a lack of progress in trade deal talks. The EU wants to negotiate the trade deal as a bloc, but individual members do not want to cede negotiating rights, which has led to an impasse in negotiations. Markets fell on the announcement, then surged earlier this week when the EU quickly scheduled several meetings to facilitate negotiations. Personal income and spending on Friday is expected to show growth of 0.3 and 0.2 respectively. Retail sales and other hard economic data have been stronger than expected so far for April, and personal income and spending tomorrow should be a confirmation of that strength. PCE inflation on Friday is expected to show the rise of just 0.1 in the headline and core series, good for annual increases of 2.2% headline and 2.5% core. The Fed is still sidelined by the threat of tariff inflation, but a headline reading at 2.2% would otherwise be something to cheer. That's all for the market update this time. Now, our discussion with Joseph Wang.
Our guest today is Joseph Wang, a former trader on the Fed's open markets desk, principal at Monetary Macro, and author of the website Fed Guy. Joseph, thanks for coming on the podcast.
It's a pleasure to be here.
Our topic today is the Supplementary Leverage Ratio, or SLR, how it currently impacts bank balance sheets, and how reforms could change demand in the Treasury market. So, Treasury Secretary Scott Bessent has said he thinks the right changes to the SLR could lower Treasury yields by 30 to 70 basis points. Fed Chair Jerome Powell and Fed Governor Bowman have also expressed support in reforming the SLR. Joseph, help us understand what the big deal is with this seemingly esoteric bank regulation. For starters, what is the supplementary leverage ratio? What's in the numerator and what's in the denominator?
Yeah, so the SLR is definitely in the news a lot. I think people often think to it as one of the potential solutions for all the hiccups we see in the Treasury market. So at a high level, the SLR is just what it means, the supplementary leverage ratio, and it is capital over total leverage exposure. So total leverage exposure is a little bit different than total assets because it would also include off-balance sheet items like derivatives. In thinking about this, it's helpful to maybe go back in time to think about how all these regulations came about after the great financial crises. So in the great financial crisis of 2008 was basically a banking crisis, right? So a lot of banks had directly or indirectly exposure to subprime and were incurring losses. And so when you have a bank that has losses, oftentimes the depositors and other lenders to the bank get worried and try to take their money out, fearful that maybe the bank might go under. After all, FDIC insurance only goes up to a certain level. So as everyone tried to withdraw their money, banks had to fire sell assets. And so you definitely had basically a bank run in many sectors in the financial, from the dealers to the money market funds to the commercial banks themselves. And so coming out of that crisis, the regulators wanted to design a system that was more robust to that. And so they came out with all sorts of ways to strengthen banks. Now, at a high level, they wanted banks to hold more capital. Now, in banking, capital is basically money that absorbs losses. So if you're a bank and you make a loan, that loan goes bust, you have losses on it, then the capital absorbs that, right? So commonly that's equity capital. So the owners of the bank absorb that. And if you have enough capital, then that means that depositors and other lenders to the bank don't have to take losses. So if you have a lot of capital, banking system becomes safer. We don't have to worry about a bank going bust and having these bank runs. So there are all sorts of regulations to try to beef that up. In addition to that, also regulations that try to limit the composition of the liabilities of a bank so that they don't have as many runnable deposits and so forth. But on the capital side, on one level, they want to make sure that banks hold capital in proportionate to how risky their assets are. So you have something called risk-weighted assets, where let's say if you hold treasuries, well, there's no credit risk to that, so you don't really have to hold your risk weighting. But if you were, let's say, making a mortgage or a corporate loan, there's some risk to that. And so a bank should hold capital against that. And so it was beefed up to make sure that the bank would hold more capital against its assets. And this is simplifying. You have all sorts of other things like stress tests and GSIB surcharges and so forth. But that was one way to make the banking system hold more capital. But then the regulators also recalled that in the great financial crisis, we had all these AAA rated things that looked really good on paper, but actually were not as safe as we thought they were. And so as a backstop to all of that, they invented the supplementary leverage ratio and the enhanced supplementary leverage ratio for the bigger banks. And so what that is that a bank would have to hold capital in proportion to its exposures, but those exposures are not risk weighted. Under the SLR, then, for example, the amount of capital you would have to hold against Treasury security is the same as the amount of capital you would have to hold against a corporate loan. So this is not risk weighted. It's totally by the size, basically, of the balance sheet, or the total leverage exposure.
That's really helpful, and I think it's important to point out that the SLR is different than a risk-weighted ratio. And I think, to me, my sense of why people think the SLR, or reforms to the SLR, could be this one weird trick to solve all of our problems is because we do have this unique circumstance where treasuries are treated the same way in the ratio as a lot of other risky assets. Now, you did mention the ESLR and the SLR, so which of those applies to what sorts of banks, or what's the difference between them?
So the ESLR would apply to the GSIBs, so that would be 5%, and the SLR would be 3%. Not all banks, but the big banks that are not the GSIBs. So I like how you mentioned that one weird trick, because there seems to be a lot hanging on this SLR to try to make the treasury problems go away. So the reason why the SLR has been perceived to be a hindrance in the treasury market is because treasuries have no credit risk and they're really liquid. And so it kind of doesn't make sense to some people that you would have to hold capital against that. And because you do have to hold capital against that, and making markets in treasury markets is not super high margin, banks seem to have cut back in their capacity or their willingness to make markets, simply because having to hold capital against these assets increases their capital costs and makes them less willing to make markets. One way you can see this is that if you look at the total balance sheet size of the securities dealers, I think as of late last year that it's about 6 trillion, and in 2007 it was 7 trillion. So 20 years ago, the securities dealers actually had a bigger balance sheet than they have today. And that balance sheet size is important because the bigger balance sheet you have, the more ability you have to warehouse securities, right? At the same time, over the past 20 years, you've seen the treasury market grow tremendously as we have large deficits, but other markets have grown too, right? Mortgages, corporate bonds, and so forth. So the balance sheet size of these dealers is important because they're basically a buffer zone, a warehouse, where if you are an institutional investor and you want to buy or sell treasuries, for example, you'd call up your securities dealer who would be able to take that off from you, warehouse it on their balance sheet until they can find another buyer to pawn it off. When the securities dealers have a big balance sheet, then they're able to act as more of a shock absorber, a buffer when you have these sudden volatile moves in the markets where, let's say, everyone wants to sell their treasuries and get cash instead, which is what we saw in 2020, right? And when you have a treasury market that continues to grow and the balance sheet capacity of the securities dealers not growing at the same level, in part because it's more expensive due to the leverage ratio, the SLR, then, well, everyone sells treasuries to the dealer. The dealer runs into balance sheet capacities, whereas they don't, in the short term at least, they're not able to take the other side of the trade. And so the cash market breaks down a bit until we have some emergency intervention. Back then, it was the Fed coming in and opening up its balance sheet and absorbing some of the selling in the market. But it's often thought of that if we were to have an adjusted SLR, maybe the dealers would be able to expand their balance sheet more and make markets in a better way. And that was the thinking in 2020 as well, when the Federal Reserve did a temporary suspension of treasuries and reserves from the SLR. There are mixed views as to whether or not that was actually helpful. I think from a theoretical perspective, it would be helpful, but there's also some research that suggested that simply because there's so much volatility, dealers would have to cut back and protect themselves one way or another.
A few things there that I want to follow up on. The first is going back to this idea that the SLR coexists with all of these other bank regulations and restraints, including risk-weighted ratios. Does the SLR end up changing bank balance sheets much, or are there other rules that are usually ending up as the binding constraint, right? Because a bank needs to check all of these boxes according to regulations. Is it the SLR that stops flexibility most of the time, or is it one of the other regulations?
Yeah, that's a really good question. And you're going to have a different answer to that depending on who you ask. Now, Jamie Dimon at his last quarterly earnings conference suggested that the SLR was not a binding constraint for JPM, but he thought that it could be for others. You correctly note that there are just so many different regulations that banks have to comply with, and every bank, depending on its business model, depending on its size, is going to have different constraints. So the SLR may not be this one weird trick that helps it, that could solve all the problems. And indeed, we can talk about why maybe it's not even super helpful. Probably may not actually be intermediation. But I think that on the margins, it should be helpful.
I want to make sure I understand this correctly. In the instances where the SLR is the binding constraint, where it does seem to hold banks back from doing certain trades, if a treasury or even cash is traded the same from a riskier asset because it's not risk-weighted, banks are thus incentivized, it seems like, to hold higher yielding assets that are a little riskier. So does it over-incentivize risk when we get up to the SLR being the binding constraint and thus disincentivize safer assets like reserves or treasuries?
Well, narrowly looking at the SLR, that sounds reasonable, but as you know, there's just so many other regulations that it's hard to pinpoint to that having increasing the overall risk appetite of the banking system. And I'll note that we had this huge stress test of the banking system in 2020 where just kind of everything imploded, but the banking system did not. It actually continued to provide liquidity to the private sector. So I think the regulations definitely worked and made the banking system much safer. It's just calibrating that such that they're not too conservative, thus choking off the availability of lending to the private sector. And we see some instances of that, right? Private credit, the tremendous growth of private credit is in part because for a lot of the banks, it's too costly from a capital perspective to make loans to these medium enterprises. And of course, it seems like the calibration of these regulations, not just the SLR, but everything together, could also be hindering the functioning of the Treasury market, which is low risk, very liquid, very important, but doesn't seem to be functioning as well as it used to.
You mentioned that the SLR was suspended in 2020 and early COVID, and my understanding is that this was to increase liquidity in the Treasury market. So, what were the impacts then, especially if banks knew that there was a time limit to the suspension, right? So, if they knew that this was going to sunset, well, they don't want to load up their balance sheet under certain regulations, knowing that a year from now, I think it was, those are going to totally change. So, what did we see during that year when it was paused?
So at that time, like you mentioned, there's a lot of things going on. And during that time, you also had lots of Fed purchases and so forth. So it's really hard to tease out whether or not those regulations were really effective in easing the Treasury market stress. Some dealers are affiliated with a bank. Those dealers would be bound by the SLR, but some dealers are not affiliated with a bank, so they're not part of that, so they're not bound by those regulations. And just looking at the differences between those two groups, didn't seem to find too big an impact on the willingness of these dealers to intermediate, whether or not they're part of the bank or not. It seemed the sense was that everyone was kind of pulling back a little bit because you had so much volatility. It was very difficult to warehouse securities at that time. But I think that was probably extreme. And usually, just in normal market functioning, I think if you do have modified the SLR to some extent to have more room under it, you should be able to have more market making activity in these low risk assets. Again, these are things that are difficult to say because every bank is under different constraints.
What do you think is the source of disagreement? I think even the idea that we use the phrase one weird trick is a bit of a pejorative. But so what's the source of disagreement between your views that reforming the SLR wouldn't solve all of the banking systems or treasury markets problems, and people like Fed Governor Michelle Bowman and Chair Powell and even Scott Bessent, what are they looking at that you think is different than your point of view?
I want to be clear. I definitely think it would help, but it's just not that magic bullet, one weird trick. So if you actually listen to the Humphrey Hawkins testimony of Chair Powell, one of the things that stood out to me is that basically many congressmen will ask Chair Powell about Basel regulations and SLR in particular sometimes. So there is definitely a big lobbying effort to get this done. So that tells me that it is impacting some businesses somehow. Now, I don't actually think that it will be the magic bullet for the Treasury market because what you really need is not intermediation capacity. What you really need when you have a $2 trillion deficit every year for the next 10 years is that you need end investors. So if you were to loosen up regulations, a lot of regulations, just so that the dealers can basically have a capacity to warehouse a lot of securities, at the end of the day, they need to place those securities to end investors who want to hold those securities, right? Be it pension funds or mutual funds, insurance companies, sovereign wealth funds, or something like that. So loosening up, increasing intermediation in the market is going to help when you have these hiccups, a lot of volatility. The dealers will be able to better buffer that. But at the end of the day, they still have to distribute that to people. So I think the more important problem is that we need to find investors who are willing to just hold all of these on their balance sheet, and not just for trading purposes, but as end investors. Historically speaking, when you have these large deficits, what happens is that the banking system actually ends up being the end investor. And we saw this, for example, in the 1940s, though that was a war, but we were kind of running very large deficits as well. If you look to other countries, let's say periphery Europe, you also see that their banks can be large investors in the sovereign debt markets of their respective sovereigns. So I think the more important magic bullet or bullets would be to be able to adjust the regulations to encourage banks to actually want to hold treasury securities as end investors rather than just intermediaries. And so right now, I'm not talking about the dealers, but the depository institutions. And that would need, I think, more work done than just simply adjusting the SLR. In fact, there's even some possibility that if you adjust the SLR, banks, seeing that they have a little bit of excess capital, might just do buybacks and just shrink their balance sheet.
Interesting. Okay, so just to be clear, as I understand it, you do support some of these reforms to the SLR because they would make the Treasury market behave a little bit more smoothly, but it's not necessarily going to, I don't know, let's say, increase Treasury demand from banks enough to offset any decline in foreign demand for Treasuries, which might happen. We've seen this in April. Have been some capital flows outside the U.S. The magnitude is still uncertain, but that seems to be what these regulation reformers are really pointing to, is this idea that we could increase domestic demand from banks for treasuries enough to offset those financial flows. But you think that is not really an equal impact.
I think that would be the goal of the administration, but I don't know if SLR alone would be enough because, like we've been discussing, every bank has somewhat different regulatory constraints. One additional thing that I'll note, though, and this goes back to what Secretary Bessent mentioned by having the yields come down 30, 40, 50 basis points. I think that what he's suggesting is just the swap spreads, which are around negative 50 basis points right now. So if you have the SLR go away, that might be able to facilitate trading, modify this trading such that you could have, let's say, hedge funds or other more opportunistic investors come in and try to close that spread a bit. So right now, it's say negative 50 basis points at the 10-year tenor. That's basically free money, right? If you're willing to hold it and have the capacity to do that. So that could come in, maybe probably not all the way, but say 20 basis points or so forth. So in that sense, there could be some additional downward pressure on interest rates from the SLR. But to your broader point, having to find investors, given that it appears that foreign investors seem to have less interest in U.S. assets, I think we'll need more than adjustments to the SLR to get the banking system to be more actively involved.
Can you give us a status check of the process of this regulatory reform? What institutions would it need to go through? How long would it take? I mean, we've already seen the Basel III endgame, take a long time to get to that draft point, and then it wasn't approved. There was such a negative kind of critical feedback from the private sector. Where do things stand now, and who are the organizations that would even change these regulations?
To change these federal banking regulations, there are three major federal banking regulators. There's the Fed, there's the FDIC, and the OCC, Office of the Currency. So all three of these regulators need to sign off on this. And I think that's a pretty hard thing to do. The Trump administration does place a very high priority on deregulation, so maybe that could be done faster than usual. So there are many ways that the SLR could be reformed. I think the most obvious way is simply to exempt reserves from it. So in 2020, the regulators exempted treasuries and reserves. After SVB, I think it's probably unlikely, much less likely for the regulators to want to exempt treasuries from the SLR, simply because we have that interest rate risk, and that was kind of a visible moment in the public of seeing Silicon Valley Bank fail. But exempting reserves are basically just cash on deposit at the Fed. So it's literally the highest form of dollars. It's liquid, there's no credit risk and so forth. So it really makes absolutely no sense to have a bank hold capital against that. And indeed, if you look at the Bank of England, over there, banks don't have to hold capital against reserves. So I think that is the easiest way to reform SLR that I think everyone can easily agree on. So reserves right now about $3 trillion in the banking system. And every bank is, again, bigger banks are subject to higher leverage requirements. And so overall, it should save a chunk of capital out of the banking system. In theory, that could be used to help intermediation. But in practice, I mean, like I mentioned before, they could simply just do share buybacks because they have extra capital. So I think it might need more, maybe prudential guidance and so forth, so that they could deploy that balance sheet capacity towards protecting this public good.
You bring up a good point, which is that any reforms to the SLR are not going to be a free lunch, except maybe exempting cash reserves, because cash really is risk-free in any way we think about it. But the regional banking crisis in 2023 showed that treasuries and the interest rate risk that come along with them, there is some balance sheet risk there. So do you think that is the risk of exempting treasuries from the SLR, is that, well, in these crisis moments where maybe there's interest rate risk, it actually is a constraint that can really create resilience in the banking system?
So that is possible. And we saw that very graphically at the Silicon Valley Bank failure. But there are also ways to fix that. For example, one of the new things we have here is a standing repo facility from the Fed, right? So in the event that, let's say, we do exempt treasuries and then we do have some kind of problem in the banking sector, they could always take those treasuries and just borrow from the Fed standing repo facility against that and get some cash. So that could be a way for these additional facilities to play a role in allowing the exemption of treasuries to work more smoothly if they were to decide to do that.
I want to end with a question that is actually unrelated to the SLR, at least directly, but as someone who is the author of a website called Fed Guy, you must have an opinion on this. As things stand now, at the end of April, we just got a ton of data this morning for Q1 GDP, in March PCE, and we've got the April jobs report in a couple days. But as things stand now, what is your forecast for where the Fed funds rate will be at the end of this year?
So I've always felt since actually late last year that we would have about 4 to 6 cuts this year. And the reason is that, so we have all these things happening, and I think the market, and certainly consumer sentiment, is placing weight on the higher inflation, potential higher inflation from tariffs and trade wars and so forth. But I think that the impact on growth is just much stronger than on inflation. And so I think in the coming months, higher unemployment rate is going to be weighing on the Fed. And given that the stance of policy, at least with reference to neutral, according to their dot plot, is notably restrictive, that we have a lot of space to go and say 100 or 150 basis points of cuts. So also, I think it's important to note that, if you look at the inflation indexes, the way they're calculated, most of that is services, not much, a smaller share is goods. And the inflationary impacts of tariffs, again, the companies will have some margin compression, and some of it will maybe passed on to the consumers as well. But that's a part of the index. Whereas when you have higher unemployment, slower wage growth and all that, that's disinflationary for the lion's share of the inflation index. So, yeah, I think we're going to get a sizable number of cuts by the end of the year.
Yeah, we're already 4 months into the year, only 8 months left, but it feels like there's such a wide range of possibilities. But thanks for that opinion. Joseph Wang, thanks for coming on the podcast.
Thanks for inviting me. It's an exciting time to be in the markets.
That was Joseph Wang, principal at Monetary Macro and author of the website Fed Guy. Joseph's experience running the desk at the Fed is evident by his depth of knowledge about the SLR and what impact removing the SLR might have on depositories and the Treasury market. His Fed funds rate call for 2025 is also a breath of fresh air compared to the market consensus in the current tariff era. Next week brings some key economic data for May, most importantly, the May employment report. The week kicks off with the May ISM manufacturing report on Monday, along with April construction spending. The ISM manufacturing report could print stronger than expected after a strong showing from the S&P Global Manufacturing PMI last week. April factory orders on Tuesday are expected to have dropped more than 3%, which makes sense given the surge in imports in the first quarter and the implementation of tariffs starting on April 2nd. The April jobs report is expected to show a marginal drop in job openings to 7.1 million. Job openings have continued to fall past their pre-pandemic peaks seen in 2019, but are far from concerning levels, and the pace of the slowdown has been gradual, which is consistent with the cooling but not stalling labor market we have witnessed over the past year. Ward's vehicle sales for May will also be released on Tuesday. Look for a drop in sales following 2 months of outsized sales numbers as consumers look to front-run tariffs. On Wednesday, ADP employment is expected to show 118,000 jobs added in May, nearly double April's increase. The May ISM Services Index is expected to rise slightly to 52, still solidly in expansionary territory despite continued tariff woes. The most important data release of the week is the May employment report on Friday. The Bloomberg Economics median estimate is for 130,000 jobs added in the month, which is just about the 6-month average for payroll gains. The unemployment rate is expected to remain unchanged at 4.2%, and average hourly earnings are expected to rise 0.3. The labor market has been quite strong over the past 3 years despite the Fed's restrictive stance, and has remained solid over the past year even as job openings and payroll gains have noticeably slowed. The week following the employment report brings key inflation data that the Fed will be closely watching for signs of tariff inflation. The New York Fed's one-year inflation expectations gauge starts the week on Monday, followed by the NFIB Small Business Optimism Index on Tuesday, which should get a small boost after the bump in consumer confidence that was reported this week. The May CPI will be released on Wednesday, with the consensus estimate for the core series in the Bloomberg Economic Survey sitting at 0.3 month-over-month and 2.9% year-over-year. Our in-house forecast, which we have updated to include some tariff price pressures, is in line with the street consensus for the May CPI. The extent to which tariff pressures are evident in the May CPI could have a substantial impact on the path of Fed funds policy. We believe there will be some price increases from tariffs, but those increases will be smaller than headlines suggest, and those increases will fall out of inflation indexes when consumer demand falls or shifts to other products and services. The May PPI follows the CPI on Thursday. The PPI fell unexpectedly in April, primarily due to a major drop in services margins, which will likely rebound in May as firms pass on some of the tariff price increases to consumers. That's all for today's episode. Thanks again for listening. I'm Mark Streiber, Economic Analyst with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments.
This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.